And welcome to another episode of the Capital Gains Tax Solutions Podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way for you to sell highly appreciated self-storage facilities, commercial real estate, save a failed 1031 exchange, exit a big GP partnership in a syndication, cryptocurrency, primary homes, you name it. If it's highly appreciated, it's worth $1 million or more. Hey, we've got an opportunity to help you defer the tax using a deferred sales trust. And so I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate financial wealth minds in the world, where they share their ideas, deal stories, and inspirations. Together, we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on expertcresecrets.com as well. I'm excited about our next guest. He is a part of the Coda Management Group, and they purchase undervalued warehouses and convert them into climate-controlled Class A REIT-ready self-storage properties, and so much more that we're going to learn about him. He's from the great Chicagoland area. Please welcome to the show with me, Scott Krone. Scott, how you doing?
Doing well. Thanks for having me on the show. I'm really looking forward to this.
Absolutely. And by the way, you can learn more about Scott Krone at codamg.com. That's CODAMG.com. We're talking all things passive investing into self-storage real estate today. But before we get there, Scott, would you give our listeners a little bit more about your story and your current focus?
Well, my background is in architecture. I got my master's degree from Illinois Institute of Technology way back in 1994. And during that time, I was a TA for my professor, who owned a real estate development, architectural, and contracting firm, which was focused predominantly on multifamily. So my background is in multifamily development. My master's thesis was a 400-unit, $100 million project that I worked on while in school, but also in his office. And so I was doing multifamily for 6 years, and then I started my own company at the very ripe age of 28, and looking back on it, probably a little too soon. But we began on this single family, multifamily side. And then when the crash of 08, 09 came, we focused on multifamily. And then 13, we began our first self-storage development. And we did that and flipped it to Compass Self-Storage. And then we've been sold off our multifamily portfolio and have been expanding our self-storage portfolio since then. And
Go ahead. Sorry.
And this past year, we just launched our own self-storage brand, One Stop Self-Storage.
Fantastic. Love that. And we're going to talk about why self-storage has been one of the safest bets in real estate in the past 50 years. $38 billion industry. 1 in 10 Americans pay an average of $92 a month to use self-storage. And that self-storage industry has a 7.7% annual growth since 2012, and so much more here in a minute. But I want to take one other step back, Scott. I want you to go back maybe to the high school days. I believe we've all been given certain gifts in this life. Some people call them strengths. Some people call them superpowers. I think they're God-given gifts. They've been given to us to be a blessing and help to others. So I'm curious, what is that 1 or 2 gifts that you believe you were given, and how does that help how you help and bless people today?
Well, I think it's a very intense question, and I say that because it not a negative thing, but a very positive thing. I would say the one super thing that I have is that I have the ability to sort of see what's coming down the pipeline a little bit sooner rather than later. And so, I was able to alter our investment strategy prior to the internet bust, and then also to the real estate bust, and then currently what we're doing now. So I'm not perfect at timing things, but I can certainly see what's happening in the landscape. So one of the things that we're doing is how we've been able to avoid a lot of over buying and making sure that we're buying at the correct level. And then what I also do outside of real estate is just my ability to help people through different situations. And so I'm willing to, provide my insight and my experience to help people avoid some of the problems that I've, seen and dealt with and learned from. So those are the things I think other people would say that about me. As opposed to what I just feel about myself.
Cool. Very cool. I like that. So see what's coming down the road sooner rather than later, and making adjustments and helping those to take action. Is that a fair summary?
That is a great summary.
Awesome. So now let's dive right into passive investing into self-storage real estate. So what's the number one secret, Scott? I mentioned some of these major stats, including there are over 48,000 self-storage facilities in the U.S., and that there are more self-storage units in the U.S. than McDonald's and Starbucks locations combined, which is pretty staggering. Most people maybe don't know about that, but Give us the number one secret to taking these stats, understanding them, and then investing passively to make a good return.
Well, the main reason why I'm focused on self-storage versus apartments in multifamily at this point in time is a few different reasons. One, it's a lot more predictable business model. I deemed it recessionary resistant. Others had deemed it recessionary proof. But we went back and studied all the major recessions from inflation all the way up through the current one, which technically wasn't a recession, but we're certainly experiencing recessionary type circumstances. And so in each of those cases, self-storage slightly dipped, but then rebounded very aggressively. And it's always stayed around 88 to 90% occupied during that entire time period. So it's a very consistent and predictable business model. And we can also go look at a specific market and ascertain what our supply and demand is, so that we don't go into situations where there's too much supply already in the marketplace. We can avoid those areas. That was something that we go ahead.
Oh, you go ahead. You keep going. Sorry.
So that's the reasons why we're doing it, is just because of it's a lot more predictable in terms of the business model compared to multifamily.
Fantastic. So predictable, recession resistant, occupying 88 to 90%. It's consistent and it's more predictable, I guess, is maybe the overall first part of that theme. Is that correct?
That's absolutely correct.
Excellent. So what's the second secret or second step to, it could even be investing with you, maybe what an investor should be asking, maybe they're looking at and they see the sexy multifamily or the sexy, well, I don't know if you can call mobile home park sexy, but you might say like it's like the thing to do, right? It used to be, but that's kind of the secrets out there too. So walk us through, a high net worth accredited investor looking at potentially investing, and you're making the case for self-storage on that first part of it, but what would be the next thing compared to those other two?
Well, I don't think anyone's ever accused self-storage of being sexy. So, but I would say that 50% of our investors are doing it for tax strategies as opposed to growth. There are three different types of assets within self-storage, and we equate them to different stocks. One would be penny, blue chip, and growth. And we're predominantly focused on the growth and the blue chip in terms of good annual cash flow, but also the appreciation. But more importantly, the different tax structures that we have set up in order to help protect or defer capital gains. So we've done everything from historic tax credits. We've done multiple cost segregations, one upon acquisition and then one upon redevelopment. So we can load up on the depreciation schedules at that point in time. And then the most powerful tool that we've implemented is the opportunity zones, which actually wipes out any tax gains. And worst case is a tax deferment, but best case is a complete wipeout of any capital gains taxes.
Okay, this is gonna be fun. So we're gonna dive into the pros and cons of some tax deferral and some strategies. It's really cool. So it gives good annual depreciation, right? So I like to say it's no longer just about cash flow; it's about tax flow. And it's always been about both, right? But increasingly more as taxes are going up, as Congress and the government are spending more, right? They're trying to figure out ways to pay for all of this, and part of that strategy for some is to raise taxes. And so, what's amazing about commercial real estate, as you mentioned, you get depreciation, and you can do what's called cost segregation. Define for our listeners the schedule. Are you on 39 years for self-storage as a commercial property? And then if you buy an average, let's say $10 million deal, I know with multifamily, we've seen you do a cost seg study, 20% of the land, typically it's not depreciable. So you get 80% of the building. Of that, about 25% you can maybe get in the first year as a kind of a good rule of thumb. I'm curious, what are some of the numbers when it comes to self-storage? Let's say if you bought a $10 million facility, what percentage of that are you actually able to do the bonus depreciation in the first year?
Well, you're right. They break out the land, and then they break out all the mechanical equipments and all the different things, and so they create the life schedule for each of those, and they create a separate depreciation schedule based upon that. So we typically have seen on the acquisition, it's maybe a little bit lower, like around 50% in the first year, and then once we improve it, and let's call it year two, then it gets higher up to like almost 60% in terms of the forced depreciation. And so then we're able to carry forward those potential depreciation losses for the next 10 years. So the average hold is 5 years, and so that's why we've done the cost segregation.
Perfect. No, I love that. So it's the challenge we found for a lot of our clients before they meet us is it's all great for the first 3 to 5 years, right? But then upon the exit, right, and a lot of the syndicators we work with, they don't do 1031 exchanges for a number of reasons. Some do, but I'd say 95% don't. The GPs just go their separate ways, the LPs go their separate ways, and then we all regroup and go at it again. Plus, in a 1031 exchange, the old depreciation schedule travels, which is not ideal. So, talk to us. Are you doing 1031 exchanges, and or what's your biggest frustration with that? And then, of course, we'll jump on the opportunity zone part of this.
We do not do 1031s, and a lot of our investors have chosen to avoid the 1031s and invest with us with the opportunity zones, mostly because of the fact that, one, you have to maintain the exact same structure and the relationship of the debt and capital stack, but also the fact that how much limited time frame that you have to identify it and then move into one. And so there's a lot of pressure to buy something that you might not necessarily want to buy, but you have to buy because of the time frame. With an OZ, we have a lot greater time frame because, let's say if you sell something, let's call it January 31 of the year, you have 45 days within a 1031 to identify, and then X amount of time to close afterwards. With an opportunity zone, you have the entire year to determine, and then you have to file your taxes. So then that determines what your real capital gain is, and then you have until June 29th of the following year to fund the zone. And then once the zone is funded, then we can apply it to a property. So you have a lot more time frame, and you can divide it. If you want to pull some of those capital gains and use it for other things, you don't have to use 100% of your gain all within the opportunity zone. You can delineate or choose where you want to put your money instead of everything all in one.
Yeah, it's speaking to the power of diversification and the power of time, right? Which to me, especially in a highly appreciated marketplace, those are your best friends, along with liquidity as maybe a next part of it, right? To be able to capture and purchase deals potentially at a discount. So that's interesting. And in the beginning, to me back up as well, you said you don't typically do 1031 exchanges because the whole entity must move and the whole capital stack, debt capital stack must be, it's equal or greater value, right? Equal or greater debt, generally speaking, for 1031 exchanges. The other challenge too is you might buy a property for 10, put 2 million into it and sell it for 25, and your sweet spot is buying anywhere from 8 to 12, right? To do the value add. Once you get over into the 25 to the 30 or the $40 million deals, which is chasing the deals up, perhaps there's even more institutional buyers that are competing at a different scale, which can also make a challenge to actually make money on the deal. Can you kind of speak to just, buying the deal based upon the intrinsic value add, not buying it just to defer the tax?
Absolutely. I mean, that's our main strategy is, adding value to things. That's my role as a developer. So we're always looking to increase the value and get the appreciation that way. So, my cousin is a main REIT buyer, and he does it for unions, and all they're doing is looking for cash flow. And so they're buying cash, and they're willing to do a 3 and a 5% cap rate, and because that's the yield that they need to capture for their pension funds. That's, if you're trying to compete against that in terms of growth, that's a tough market to be building in. And so that's why we like, the product. I mean, that's another great point. When we're doing self-storage, we're at 10% of the valuation of multifamily. And so I can create 800, 6 to 800 units at 10% of the cost of multifamily. And so I can diversify and reduce risk dramatically because of that compared to multifamily.
That's a great point, especially with construction costs going higher and higher and higher, right? And a lot of challenges there. And by the way, I also want to touch on the 1031. I call it the shotgun wedding, right? The 45 days to get engaged, the 180 days to get married. And it's just not great. I was at Marcus and Millichap in 2006, and everyone's giving high fives when they were sellers. They hated to be buyers, but they didn't want to pay the tax. Then the music stopped, and I saw some lose half or all and had to dig themselves out the next 3 to 5 years. And one thing we identified was the 1031 exchange, right? They would not have purchased the property if it wasn't for the capital gains tax of 30 to 50%. And they felt trapped by that. And so they just kept doing it. And then they got hurt, right? Because they didn't have enough diversification, enough liquidity. They had too much debt. And so we quickly learned about a deferred sales trust in 2009, and we started to use that as a way to eliminate the need for the 1031 exchange. We actually just did it for a syndicator out of a $20 million deal out of Vegas. They sold a multifamily property, and they also don't do 1031 exchanges for all the reasons we talked about, but they put their GP interest into these trusts. And then they did another $16 million multifamily property, and the same thing. They put their GP interest into the same trust. They kept kind of piling it up, and then they can use the funds to go back into their own deals, all tax deferred. And I think it's the Netflix, the best kept secret to the commercial real estate world. Most people don't know about it. Some people get it confused with the Delaware Statutory Trust, which is another form of 1031. But I'm curious, have you ever heard of a deferred sales trust? And what I'm saying resonating with you?
I have heard of it, and we have not implemented it. We're in the expansion growth period at this point in time, and so our model is to develop a portfolio between $100 million and $150 million, so that we can then liquidate it at that point in time. And so we're in the expansion. So when we get into the liquidation, then we will certainly be exploring those options.
Excellent. Yeah. Well, and also to that point, we can do some estate tax things too. I think sometimes the tiger by the tail is just the cap gains taxes, which the opportunity zones, which I want to dig in a little bit more on some of what you have going on those. But that's just the cap gains tax. That's the tiger getting by the tail. The elephant in the room is the estate tax. That's 40%. And those exemptions are set to be cut in half in 2025. Biden's also maybe proposing to take it to 7 million married, 3.5 single. I've even heard like even lower than that. I won't even go there. But that's like a big thing right now, right? This massive amount of wealth that's transferring without having to buy insurance, give it all away to charity, or do all the gifting. We're using what's called the DST 2.0 to move all the funds outside the taxable estate in one transaction. We just did it for a deal in Colorado for a client. They've been in real estate their entire life, $25 million client, and they sold a $5 million asset, no basis. And their biggest thing of using the DST 2.0 was to be able to move it outside their taxable estate to save that 40%. So that's also something that any of our listeners want to learn more about that, they can go to capitalgainstaxsolutions.com and we can strategize on that. But let's dive back into the Oz part of what we were talking about. Are there some opportunity zone deals that you're working on right now that people are selling cryptocurrency or businesses or real estate that can take advantage of? Do they need to be accredited? What does that look like if they were going to work with you, Scott?
So we created the first opportunity zone in PACE deal in Northwest Ohio, and it may be in the country with the combination of those two things. It was a privately funded PACE project, and we did it back before the regulations even came out. In fact, I was on the phone with the IRS trying to understand what the rules and regulations were going to be, because at that point in time they'd only published the 3/4 of a page of the legislation. And so we implemented at that point in time because we found out that our property wasn't in an OZ and we hadn't closed on it yet. And so we went to our investors and said, hey, would anyone be interested in this? And we had people come forward, and we created it for them. So our opportunity zones, we don't charge anything for our investors on it because they're investing in our projects. That was something that we just created and did for them for their benefit. And then the following Christmas, everyone came back to us and said, when are you going to do your next one? And so our next two projects, we've had 3 projects in the opportunity zones where we've raised money in a significant portion of our overall capital stack is opportunity zone funds. And so that is how we've structured them. And it's the primary thing, because you pointed out, I think that we're going to go into a full-blown recession depending on what happens with this upcoming tax code. I mean, between attacking the 1031s, attacking the capital gains, and all the different ways in which in trust, inheritance tax, those are the 3 major tax shelters that investors go to. The only one that they're not attacking is the opportunity zone, because it was actually established in the Obama administration, in which Biden was obviously the vice president. But they didn't choose to do anything with it. It sat dormant and idle until Trump came into office, and then Trump began promoting it, and then that's where it came into full legislation. The gentleman who created it was Steve Glickman, and he was literally twiddling his thumbs in the Obama administration because they would not touch it. And so when Trump came in, because he was, according to Glickman, trying to deflect a question, his phone started ringing off the hook, and that's why it became the most bipartisan agenda and legislation that was passed. because both sides saw the power and recognized it. And it's an incredibly funded program. And so there's, originally Biden on his campaign webpage was talking about how he was going to talked about changing or implementing social change within it, which I don't know how the IRS would actually monetize or determine what amount of social change had been productive. To me, that's the biggest challenge of what he was proposing. But since that period of time, he's been absolutely silent upon opportunity zones. So I think opportunity zones is one of the few things that has not been, thrown out there as how they're going to impact taxes.
Yeah, very well said. We get that common question too with the deferred sales trust. We go, hey, they're taking away the 1031 exchange. Does that mean you're taking away the deferred sales trust? Like, no, it's not even being talked about. It's completely separate. It's based upon IRC 453, which is just an installment sales to seller carryback. And so it's separate. But I want to focus on opportunity zones. Maybe we can give a quick example for some of our listeners. Let's imagine you bought, Bitcoin for $1. It's worth $1 million. You have all this gain. You sell it. Okay. You move it into an opportunity zone. You hold it for 10 years there, right? You got to pay some tax, I think in year 3, maybe 4, right? You got to pay. But then but then at that point, you can grow tax free on a lot of where you're at. So just walk us through that, some of those benefits just briefly, and what that potential, I know it's, no promises here on your self-storage facility opportunities, but just what you think might that $1 million turn into over like a 10 to 12 year period of time.
Well, first of all, I'm not a CPA, so please rely upon your own tax attorney to advise you on this. So our understanding of the tax laws based upon our conversations with the IRS as well as our own CPAs is this, that think of it as like an IRA. You cannot be a disqualified investor. So you as the investor can invest in a fund. The fund can then invest in a third-party project. That's how we've set it up. So if A is the investor, B is the fund, C is the project. So the fund is actually a member in the entity that owns the LLC. So when you deposit money into the account, it immediately becomes tax deferred. And if you invest in 2 years and then you pull it out of the fund, you deferred your taxes for those 2 years. It's at year 5 that you begin to diminish your tax liability on that capital gain. So if you have that $1 million capital gain, then it's deferred until 5 years. After that, your tax basis on the capital gain gets reduced. At 7 years, it gets further reduced. At 10 years, it's completely wiped out as long as it stays in the fund. If we sell the property, we can then buy another asset to maintain it because of the fact that the money has not left the fund. In addition, as you pointed out, the growth in the fund is tax-free. And so that's why it's one of the most powerful tax tools out there because, keep in mind, the original tax code was designed to encourage growth. It was designed to encourage risk. And there's a value to that risk. And they're saying, okay, look, if you're willing to take that risk, then we're willing to give you a reduction in your taxes because we identify that you are doing something on the benefit of the country by risking your capital to help the economy grow. And that's my biggest complaint about what's with the approaching of the tax code and altering it is they're no longer recognizing the risk that investors do take, and they're no longer willing to give people that benefit for taking that risk. And to me, that's inherently the biggest, the problem that I have with the modifications to the tax code.
Yeah, I couldn't agree with you more. And I did hear that they're actually easing up on the 1031, and they, again, it's not finalized, but there's thoughts of they're not going to be taking that away. Maybe like we thought maybe it were a few months back. And then also the stepped up basis, right? Looks like that's off the table. Again, we'll see what finally comes through, but these are all things to consider and to make sure that you're doing planning with your CPA, right? Or connecting with us if you're looking to clarify some capital gains tax deferral options, or getting with Scott if you're looking at the opportunity zones. By the way, you can go to codamg.com. That's codamg.com. Scott, all that being said, we're running out of time. You ready for the lightning round? But right before we go there, I want you to mention real quick, accredited investors, current self-storage opportunity fund. Would it be just going to codamg.com if people want to learn more about that?
Yes, we do work with accredited as well as sophisticated. We can have a limited number of sophisticated investors. But now the changes in accredited, most sophisticated are becoming accredited. The other thing I'd like to point out is the real risk is that if they do make the modifications to the IRA Roths, people that have assets with IRA Roths are going to be under tremendous pressure to liquidate their assets so they don't compromise the entire IRA Roth. And that is one of the major tax things that are coming down the pipeline.
Yeah, let's actually touch base on that a little bit more. Would that also mean, would opportunity zones be a solution for that potentially?
They would be. But obviously the challenge is that, there's a limited amount of properties that are in opportunity zones. So
Right.
the question is, how are they going to expand it and how are they going to continue it? Because the opportunity zones was a 10-year program.
Right.
And so, they're going to have to be looking at how they continue and how they further expand it.
Right. That's a great point. And I mean, I've seen a lot of deals and I've drew a lot of deals and I invest in real estate deals. And it just seems like it's really hard to find that diamond in the rough that's also an opportunity zone. It's tough to find deals in general, but especially in opportunity zones. That's why you do want to get with folks who have a value add approach, a track record already in place, that have been doing this for many years, like Scott Krone and his team, so that you're not letting the tax tail wag the investment dog. You're just letting the dog wag the dog, and then you're happy to get the benefits on the tax incentive. So, Scott, any last thoughts on that?
No, I agree with what you're saying. And, that's one of the things that we do is that we're buying, assets that are, $13 per square foot. And then we're converting it into something differently because they were not able to sell at the valuation they were hoping. So that's the main value add.
Excellent. You ready for the lightning round?
I am.
All right. Knowing what you know now, if you can go back to your 25-year-old self, what's the one golden nugget you'd make sure to tell yourself to do?
Be more patient. You don't have to rush to start your company at 28. Make sure you get a good team and understanding of what's going on and develop that and build that and get your experience. It will help you down the road.
Fantastic. Second question, what's the number one book you've recommended or gifted the most in the past year?
The Road Back to You by Ian Morgan Krone, Krohn, no relation, no royalties. It's a great book about personalities and understanding your own self, and then also understanding others. And the concept was developed by 4th century monks, and it's very applicable even to today.
Fantastic. We're big fans of the Rich Dad, a Poor Dad, philosophy books, everything Robert Kiyosaki. So just curious, what's the one part of the Rich Dad, Poor Dad strategy that you try to implement, or any wisdom that you can share with our audience about that?
Buying right. That's the whole thing, that we make our money on the acquisition, not on the sale. And so we're not planning on that. And, we have to buy below what we feel is market price, because ultimately we have more ability to correct or stay competitive if we don't overpay on the front end.
Fantastic. Second to last question, what are you most curious about right now?
I'm most curious about what's going to be happening down the pipeline. I'm spending an enormous amount of my time just researching, understanding what's being proposed and what are the repercussions of it. It's a huge factor that we talked about with the IRA. A significant portion of our investors have IRAs and have done it for the tax, shelter portion of it. And if they're under the pressure that they have to liquidate, it's going to change the landscape tremendously, because everyone's going to be selling, and the question is, who's going to be the buyer?
Very well said. Last question. After all the people you've helped, building the company you've built, and investing and developing and doing the deals you've done, how do you stay centered in your values, and how do you still stay encouraged to charge forward to reach new heights?
I began a 2-year program with the Transforming Center that works on leadership. Majority of people are in the ministry, but I've chosen to do it. There's about 20% of us that are not, that are just leaders, and we're looking at the program to develop our leadership skills. And so that is how I'm investing in myself. We're in our fourth quarter. I guess it is fourth quarter, because we meet quarterly out of a nine quarter program. And so that is how I'm doing that right now.
Fantastic. Scott, I want to thank you for being on the show. I want to encourage you to keep using the gifts that you've been given of seeing what's coming down the road and reacting sooner rather than later, and helping people create and preserve more wealth in self-storage investing. For our listeners who want to get in touch with you, would you remind them one last time what's the best place for them to find you?
Well, Brett, what I'd like to do is offer each of your investors a gift, or your listeners a gift. If they mention this show and they email us at info@codamg.com, we will send them a feasibility report that we've hired by a third-party feasibility consultant. and it explains the self-storage market. It also explains why we chose that market and what we look for, so that people can get a better understanding of the self-storage industry. It's about a 175-page report, and we'd be more than happy to give that to any of your listeners who reference this show.
Fantastic. Thanks, Scott, for being on the show. And also thank your listeners for listening to an episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust or opportunity zones with someone who's a proven track record, self-storage developer, owner, all of the above, value add investor, Scott Krone, is the best way for you to grow your wealth. We encourage you to go to capitalgainstaxsolutions.com if you want to learn about the Deferred Sales Trust, and get with Scott again at codamg.com to learn more about opportunity zones and self-storage investing. Also, we're also streaming this on Expert CRE Secrets for our commercial real estate brokers out there, M&A advisors, business brokers. We're hoping that you're enjoying this content and you're thinking about how this can grow your business by solving problems for your clients. And if you want to level that up and look at coaching and how we help our strategic alliances across the U.S. do that, you can also go to experttaxsecrets.com. That's experttaxsecrets.com. Hey, please rate, review, subscribe. Please share this with somebody who could help. We so appreciate everyone out there, and we'll